Governor of the Central Bank of Barbados, Mr. Cleviston Haynes, Mr. Mariano Browne, a former Minister of Trade and Industry and Minister in the Ministry of Finance in Trinidad and Tobago, Mr. Timothy Simmons, CEO of the Enterprise Growth Fund Limited, members of the board and staff of the Enterprise Growth Fund Limited, specially invited guests, ladies and gentlemen, good evening and welcome to a public lecture hosted by the Enterprise Growth Fund Limited, which is celebrating its 21st anniversary. The organization was set up on January 2nd, 1998, and its mandate was to lend to small and medium-sized businesses. It started with 2 members of staff and has since grown to 12 members. It facilitates the growth of companies in areas such as agriculture, tourism, and also energy-smart organizations. It prides itself on being lean and mean and using technology to its best advantage. Tonight's topic is a love affair with national development banks, separating facts from fiction. And tonight's lecture should be very interesting because there's not a day that goes by on the call-in programs that someone is not saying that the reason why Barbados is where it is because we no longer have a national bank. I will now invite Mr. Timothy Simmons, the CEO of the Enterprise Growth Fund Limited, to introduce tonight's speaker. Mr. Simmons.
Thank you, Master of Ceremonies. Governor of the Central Bank, Mr. Cleviston Haynes, Mr. Mariano Browne, our featured speaker tonight, Mr. Conde Riley, Chairman of Enterprise Growth Fund Limited, fellow directors of Enterprise Growth Fund Limited, past directors of Enterprise Growth Fund Limited, distinguished ladies and gentlemen. It is with a sense of pride that I stand to introduce tonight's speaker, Mr. Mariano Browne, who really needs no introduction, as most of you already know him. However, it would be remiss of me if I did not make some brief personal remarks about this gentleman and colleague with whom I worked between 1998 and 2007. First as a director of Enterprise Growth Fund, and subsequently as the second chairman of Enterprise Growth Fund. Mariana brought an energy to the institution that was untamed. Young, with a raucous laugh, robust, full of ideas, bursting with all the management theories of the day and wanting to implement them all at once. Together, we navigated the troubled waters of a startup institution with its unique challenges, its goals, ideals, and strategies. A trained economist and a chartered accountant by profession, Mr. Browne spent many years in the financial services sector in the region before becoming a cabinet minister in 2007 in Trinidad and Tobago. He served as senator in the upper house and held 2 portfolios simultaneously as minister in the Ministry of Finance with responsibility for state enterprises and Minister of Trade and Industry. He's experienced in matters of economic policy formulation and implementation. Ladies and gentlemen, it is my distinct pleasure to give you a man for all seasons, Mariano Browne, the accountant, banker, economist, strategist, and Caribbean thinker par excellence, to speak on the topic, the love affair with national development banks, separating facts from fiction. Ladies and gentlemen, I give you Mr. Browne.
Thank you very much. The Honourable Minister Edmund Hinkson, Minister of Home Affairs, Mr. Cleviston Haynes, Governor of the Central Bank, Mr. Conde Riley, chairman of the EGFL, board members, specially invited guests, staff. I'd also like to recognize a former Central Bank Governor, Dr. Mariano Williams, and the president of, I think, Sagicor Life, and one of the initial contributors to EGFL Fund, Sagicor. I want to thank you for making it possible for me to come tonight and to give this presentation, and for you, the audience, for coming to listen to the presentation. First of all, it's an honor for me to be here. Last time I was here speaking, I think it was doing a presentation. I think it was on commercial banking, and Governor Mariano Williams was the governor at the time. And that would have been about at least 20 years ago. So that dates me in real terms. And I was just thinking that I might not be the best person to make this presentation, because my experience has been primarily in the private sector and primarily in the commercial private sector, commercial banking. And having spent much more time in this market segment than in development banking. And my time as chairman of EGFL perhaps was all too short, all too brief for me to learn all the lessons that I needed to. So you can see I've had the opportunity to learn them at a different level, and from mistakes made in not only during my tenure here, but also during my period as a minister in government in Trinidad. And even that in itself also has some limitations, in that perhaps you could say I didn't spend enough time as a minister. Maybe that was a good thing too. Right. Though I must admit that one of the major lessons to be learned, and I think that one that I want to talk about, I certainly will end up with it, is that it isn't so much the institutions that you form, but the enabling environment that a government is required to create. I think that's the most important lesson. And in that sense, you could say that I've had at least experience in crafting one manifesto, which was even longer, that's in 1991, and setting out a series of economic policies, which I think Trinidad and Tobago has managed to live with in spirit, if not in practice, for the last 28 years. So by background and experience, my approach is much more pragmatic than it is philosophical. And in that regard, I point to Deng Xiaoping, perhaps who never held office, held political office, that is, was never recognized as being a formal member of the Politburo, but nonetheless is responsible for all the changes that we could see with regard to China and China's emergence within the last 25 years. And his position was very, very simple, very simple. In fact, he spent a few years in jail for it. And his position was very simply, it doesn't matter whether the cat is black or white, as long as it catches mice. All right? The allegorical interpretation of the cat was the economic system, whether it was capitalism or communism. And I don't think Mao took too well to that. I have to say that I also suffer from that in Trinidad and Tobago. I haven't spent any time in jail as yet. And since I haven't held the reins of power, I have not had the luxury of being responsible for the policy choices, so I can much more easily theorize about what we ought to do or ought to have done than if I were the incumbent and had to defend what I did. And my time in office perhaps was a much more generous time. Our fiscal position was a lot simpler. Trinidad was enjoying a bit of a boom, though I must say that 2008 and the emergence of the difficulties from 2008 certainly challenged us from a fiscal point of view and caused us to rethink our position and certainly to craft different policies which have not necessarily been adhered to since then. I think the first point that we have to note, and this is particularly with regard to Barbados and to the smaller islands, wherever they are, and smaller countries in the world, is that we live in a digital age. So the internet allows us to follow and track development everywhere, on all our devices. We are integrated from laptop, phone, or tablet. But technology is a two-edged sword that facilitates rapid dissemination of information as well as contagion. And that is one of the major lessons to be learned from the 2008 financial crisis. That the interconnectedness of technology has facilitated the integration of financial markets, as evidenced by the global financial crisis of 2008, when the failures in the US market affected most Western economies in one form or another, though Canada is a notable exception. The recovery process has been long for many countries. Recovery has depended on several factors: economic strength, diversity, trade resilience, domestic capacity, its framework, and regulations. Many OECD countries are grappling with political volatility resulting from the negative feedback of the effects of globalization, immigration, job losses, and societal change, such as aging populations. Brexit, America First policies, and the changing political face of Europe exemplify these changes. Developing countries are beginning to understand that notwithstanding the articulation of the Millennium Development Goals, we cannot rely on developed countries to lead or to provide aid. Indeed, the success of globalization and the improvement in the trade mechanisms as development tools has led to a backlash as evidenced by the America First policies. The BRICS have responded to ensure that their development and their place in the world is buttressed by their own efforts. India proposed the creation of a new development bank at the 4th BRICS Summit in 2012, and this proposal was accepted at the 5th Summit in 2013, and in 2014 at the 6th Summit, the states, the BRICS signed the agreement to form the bank, and by 2015, the BRICS has set up a currency reserve pool of approximately $100 billion US, and by 2016, the bank had successfully issued its first green financial bond, fittingly in China, of renminbi $300 billion with a tenor of 5 years. In August of 2018, the bank received a AAA credit rating for S&P Global Ratings and Fitch, and is now known as the New Development Bank. In 2014, Nobel Prize-winning economist Joseph Stiglitz said that the National Development Bank, the New Development Bank, represents a fundamental change in global economic aid and political power. In his opinion, the existing institutions don't have enough resources. Now, that's a very important point. The existing institutions, and by existing institutions, he's talking about the larger multilateral development banks, such as the World Bank, the IDB, the Asia Development Bank. So to address the issue of sufficiency of resources, at least for the Asia-Pacific region, China has also established an Asia Infrastructure Development Bank, a multilateral development bank that aims to support the building of infrastructure in the Asia-Pacific region. The bank currently has 87 members, or 87 member states from around the world, and it started operation after the agreement was entered to on December 2015. The United Nations has addressed the launch of the Asian Infrastructure Development Bank as having the potential for scaling up financing for sustainable development. And the starting capital of the bank was again $100 billion US, equivalent to 2/3 of the capital of the Asia Development Bank and almost half that of the World Bank. So in other words, we're beginning to see the emergence of different development banks, multilaterals in themselves, in a sense led by China, which will take on the other Western development banks. Just let me see if I can get I did a little presentation here, which should bring us, where am I? So what is the development challenge for the Caribbean? I think we need to remember the challenge was once at the epicenter of the world's economic system. In the 18th century, so it's a couple of years ago, when sugar planters were the conspicuously rich men of Great Britain. The proverbial phrase for comparing one's standing was as wealthy as a West Indian. Try that on today. The planters gained political preferment and exercised preponderant influence in and out of Parliament. Sugar was king, and those who produced it constituted the power behind the throne, and the islands on which the opulence and commanding position had been reared were regarded as the most valuable of all possessions. And that is why after the War of 1767, what is known as the War of Jenkins' Ear, Canada was ceded in exchange for Guadeloupe and Martinique by the French. Not necessarily the best deal that they could have done. But that was then. Monopolies never last forever, and by 1800, new and larger colonies had emerged to erase the Caribbean's monopoly, and the mercantilist system on which it was built. By the 19th century, the emergence of free trade and the beginning of the development challenge, a challenge for which we have only now, within recent times, certainly within the independence, begun to address in any systematic way, when we assumed responsibility for our own destiny at independence some 50 years ago, like most post-colonial societies. So where are we today? Governments are not immune from the effects of the digital age. Aided by technology and data sharing, citizens are more outspoken and less patient with their demands for improvement in their standards of living, as amplified by better infrastructure services, increase in income and purchasing power and employment. But development is a long-term exercise. It requires foresight, long-range planning, strong institutions, stable management and leadership, and building capacity in the human resources of the country. National development is the responsibility of the entire country, and it requires an all-hands, all-on-deck approach. But government has the critical role of policy formulation and studied review of those policies. The message of the 2008 financial crisis and every crisis that the region has faced since the 1800s is clear. The Caribbean must adapt and improve its response to the challenges of the New World Order. That means less reliance on aid and assistance and greater emphasis on national and sectoral development. Today's topic is an important one as it forces us to confront the fundamental challenges facing development in the Caribbean, to explore the effectiveness of our responses to the development challenge, and to identify the blind spots in our policy and ideology, even as we face the middle income trap, which prevents or limits our borrowing on preferential terms from the multilateral development institutions. The current economic fortunes in the Caribbean shows high debt to GDP ratios coupled with low growth, high or rising levels of unemployment, weak private sectors, and open economies. The IDB outlook suggests growth projections only indicate a convergence to the region's long-term average growth rate, which is well below those of other regions and below world growth rates. Two are in the midst of fund programs, no names called, with a third, Trinidad and Tobago, edging inexorably towards such a program. Our economies have remained tied to one dominant sector, commodity or service. Tourism, oil and gas, financial services have replaced sugar, although sugar limps on in some countries. Economic diversification is limited, and the observations that I made before, which came from Ragatz, the rise and fall of the planter class, still ring true in many senses. The fundamental problem facing the Caribbean is the same issue facing us in 1800. Sustainability, scale, and sagacity. Then, as now, changes in the global economy buffet the ship of state in addition to the effects of climate change. Economic growth and development are important priorities of all governments, even if they vary in the policy measures or prescription used to pursue this growth. The Arthur Lewis model remains the most used model of development. It was certainly used by the Asian tigers with a greater degree of flexibility in its interpretation than is characterized by the Caribbean experience. Perhaps we have been too slavish in our interpretation of the model, and we have not consistently harmonized our developmental objective across all sectors and followed through with the follow-through necessary to monitor and measure the effectiveness of the measures and tools that we employed, and to consistently discard that which was inappropriate. Irrespective of the model employed, governments recognize that improving the standard of living, facilitating economic growth, is inextricably linked with the issue of national development. The main ideological and philosophical divide between different development models lies in the role of the state. It is the state that must initiate the scope and rate of intervention and or stimulation, but the private sector must assume the lead in the follow-through. Which is more important? Achieving meaningful and sustainable long-term economic growth in the region has been stymied by the the size of the financial sector, and the need to grow externally, which often forces us to balance competing needs with political realities. Development plans are often simultaneously based on or frustrated by the 5-year time frame of our political cycles. As a result, the political director tends to limit and or equate development with infrastructural development. It is easier to point to physical accomplishments than the key developmental needs, which are more often than not institutions, procedures, and systems which are not very sexy, though they have greater influence on achieving a self-sustaining dynamic. Infrastructure projects are tangible, they are visible, and support and cement a narrative that the government is working. More succinctly, it helps secure votes. At our own peril, we have relegated more critical aspects of development, crucial to our long-term survival and viability, to a secondary position. I'm referring to our failure to strengthen and develop our institutions, people, processes, and improve the ease of doing business. The current chair of the US Fed, Jerome Powell, sums it up nicely. Long-term economic growth depends mainly on non-monetary factors, such as population growth, workforce participation, the skills and aptitudes of our workforce, the tools at their disposal, and the pace of technological advance. Fiscal and regulatory policies can have important effects on these factors. Development comes at a cost, and oftentimes the critical issue is who will bear the cost. How do we fund the development requirements, and how do we implement it? What is referred to as the implementation deficit may be more associated with overly ambitious timeframes and weak institutions. The private sector in the region may have the organizational capacity to effect change, but will not take up the mantle unless it sees defined opportunity, stability, and confidence, and an attractive rate of return that offsets the substantial risks involved. Financial resources are also limited in the financial sector. This sector is also timid, but there are enough examples to suggest that once businessmen understand what is required, they will rise to the occasion. The development task then is to ensure that there are many such firms that are growing proof from which they can emerge to grow and prosper without forgetting their roots. So how can this be achieved? Government, on the other hand, has a broad responsibility in the process of national development. It is responsible for planning, policy creation, prioritization, communication, and enabling the development agenda by the creation of an enabling environment to foster growth and development. It is directly responsible for development activities through its policies and programs. But government realistically has only one tool at its disposal: fiscal policy. And through it, the influence to coordinate a few critical macroeconomic variables. Monetary policy works very slowly, so it is not a key factor or driver of change. It is through fiscal and trade policies an enabling environment is created to encourage and optimize the efforts of others in the economy, especially in the private sector. But to do this requires sharp, bright people in the private sector and in the public, both speaking the same or similar language. Our recruitment and promotion systems must be calibrated to ensure that we keep producing people with that vision and action orientation. Sustainable national development cannot be achieved by the government or the private sector, each acting on its own. It requires cooperation, consensus, and working together. However, the unfortunate reality in Caribbean developing countries is that the private sector must be prodded to take the lead and invest, and both sectors are equally mistrustful of each other. Too often, government overstays its usefulness in certain targeted sectors, leading to unsustainable subsidies, or state enterprises hindering long-term private sector growth and capacity building. The housing sector in Trinidad is a fitting example of this. Increasing private sector participation in the economy and in economic diversification requires an enabling environment and that the country's financial system is robust enough to facilitate the development. Funding for the development and innovation must be available and accessible to both the government and its agencies and different levels of the private sector. Sometimes local infrastructure projects are expensive and a little bit more risky. As a result, domestic commercial financial institutions have little appetite for such projects, or in funding SMEs, which by definition have a riskier profile. To address this lacuna in the financial sector, governments, both in developing and developed countries, have used development banks to provide funding to these riskier areas or niche sectors which are inadequately serviced and or neglected by commercial financial services. Development banks gained prominence in the post-World War II era, when the focus of many nations was rapid industrialization and or reconstruction. National development banks played a critical part in the development of many countries, including Brazil, Korea, Mexico, Canada, the UK, Germany. Even in the US, there was the War Finance Corporation of 1918, the Reconstruction Finance Corporation in 1932, which formed a model for the German KfW, and there's also the North American Development Bank, Freddie Mac, and Fannie Mae, which have a more precise purpose. The point is that many of the multilateral development banks generally frown upon the development banks in development countries for the very simple reason that they consider tools and arms of government, which are unprofitable. The point is that it has been used by everybody. And that, as you see, the number of development banks there are worldwide and how many of them are international and regional and sub-regional banks. We also have one, of course, that is called the Caribbean Development Bank. That is not the topic of today's discussion, though there are a couple of things I'd like to see in that, but not for today. Today, national development banks are considered an important government tool for earmarking credit in the financial landscapes of both developing and developed countries. A 1998 study by Nicholas Brook notes that there are 550 development banks worldwide, of which 520 were national development banks. These are in 185 countries, and the UN has 193 members, so that really indicates the fairly high level or the fairly high and extensive use of development banks. With developing countries hosting an average of 3 or more NDBs. Latin America and the Caribbean have the largest number of national development banks, 152, followed by Africa, 147, and the Pacific, 121. Europe, 49, and West Africa, 46. But it's important to note that Latin America, notwithstanding the largest number of national development banks, also have the lowest long-term growth average of all those regions. The scope and operations of the national development banks have expanded over time. They fund many areas, including microfinance, insurance mechanisms, small and medium businesses, niche marketing, and they are at the forefront of green and climate change mitigation funding, credit allocation, and advisory services. The Caribbean National Development Banks tend to be sector-specific and have the narrower scopes than their counterparts in Europe or elsewhere. But what exactly is a national development bank and how does it help the country? There is no standard or accepted definition for a bank or for a national development bank. The OECD defines it as a specialized development bank or a subsidiary set up to support the private sector development in developing countries. They are different from their larger multilateral counterparts, such as the World Bank or the Inter-American Development Bank, or regional institutions such as the European Development Bank, the Asian Development Bank, the Caribbean Development Bank, or CAF, which is in Latin America. It is possible for the NDB to be bigger than a multilateral. The Brazilian National Development Bank has a much bigger loan portfolio than the IDB. National development banks tend to be majority owned by national governments and source their capital from national or international development funds or benefit from government guarantees in raising money in the open market. This ensures their creditworthiness, which enables them to raise larger amounts of money on international capital markets and provide financing on competitive terms. The World Bank highlights the fact that in different countries they have different names. Policy banks in China and Vietnam, development financial institutions in Malaysia, public or development banks in Latin America, and national promotional banks in the European Union. The World Bank notes that it refers to any type of financial institution that a national government fully or partially owns or controls and has been given an explicit legal mandate to reach economic goals in a region, sector, or marketplace. National development banks come in very different ownership and operating structures, funding mechanisms, and clients. The critical defining factor on whether a financial institution falls within the ambit of a national development bank is its purpose, mandate, or ownership. Advocates argue that they serve at least 5 vital roles in the development process, counteracting the pro-cyclical behavior of private financing. First, by promoting innovation and structural transformation inherently required to dynamize economic growth, enhancing financial inclusion, i.e. bringing new sectors that would not ordinarily be financed into the process, in the financial circles. 3, supporting the financial infrastructure investments, which is also crucial for economic growth. 4, supporting the provision of public goods, particularly combating climate change and more broadly promoting environmental sustainability and green growth. In several countries, development banks are also active in rural and export financing, as well as in the investment of risk capital in specific firms or projects associated with the development mandates, a little bit like the EGFL, and provide access to technical information through technical cooperation agreements. The question is, do they really do this in practice? What does the research and findings tell us? And do they support these positions? And what are the lessons to be learned? First, and these lessons, there are 7 points. They come from a study which is done by the World Bank, which looked at all of the development banks across the world. And they made some very broad generalities in terms of practice. And the first point that they make is this one. There is not enough data and or detailed studies on national development banks. The bank concluded in its 2017 survey that there are only too few studies focused exclusively on national development banks. The ones that have been done are limited to an examination of a single or a small set of institutions: Brazil's National Development Bank, China Development Bank, KfW in Germany, Fannie Mae and Freddie Mac in the United States. Additionally, there has been limited analysis of the sectoral focus NDBs and few case studies which address the impact of the national development banks in specific market segments. It concluded that there is a need for a wider study of development banks on a systematic and a comprehensive basis, and that much of the literature on state-owned financial institutions has focused on examining their financial performance rather than researching on their wider economic impact. The IDB, however, does attempt to use a development effectiveness matrix, which is now becoming the standard for evaluating the capacity and or the ability of the development banks. And the bank measures the evaluability of developmental interventions with a set of development effectiveness matrices, which are based on good practice standards produced by the Evaluation Cooperation Group. And there are a checklist of analytical and informational requirements. In other words, there are tools available to do this. We are now beginning to develop the mathematical rigor to do what we would consider to be a more rigorous assessment of the capacity and or the contribution of the development banks. But we are only at the beginning, and this is a specific area of research, and perhaps that EGFL may want to take it on. The second point the literature provides no clear established consensus on the effectiveness of national development banks on economic growth. The World Bank points out that the prevailing literature on NDBs are polarized between the interventionist view and the laissez-faire view. In the past, of course, in the region, we have been acutely influenced by the laissez-faire view. The former the interventionist view favors active government participation in the provision of financial services, and the latter opposes, the laissez-faire view, opposes government interference in the economy because of the distortions it can create. The laissez-faire view has dominated academic discussions in recent decades, with economists like Chandrasekhar concluding that irrespective of policy orientation, the failure of private financial markets to deliver adequate long-term finance forces the government to rely on development banking institutions. In other words, there is a failure, and the private sector has failed in terms of addressing certain specific areas. The third point, national development banks are particularly useful during times of economic downturn and depression, as they play a counter-cyclical role. In many jurisdictions, national development banks played a counter-cyclical role by helping to mitigate the impact of economic shocks, particularly in response to 2008, acting as a stabilizer and deleveraging private banks. In times of economic crisis or downturns, many NDBs review their loan accounts and restructure loan repayment terms, interest rate reduction, maturity extensions where applicable, increasing availability of liquidity for financial intermediaries and medium-sized and/or small to medium-sized enterprises, including guarantees for financially constrained SMEs and increasing financing to local governments because of the reduction in federal transfers during the crisis. That is particularly true, of course, of the developed countries. Studies have also confirmed that national development banks behave counter-cyclically during crises. One, the fact that their objective function in crisis is to aid economic stabilization and not to maximize profit through risk. Two, the ability to be capitalized by governments. Three, they have less withdrawal and rollover problems as governments have higher credibility. And four, their funding structure requires less central bank or intervention. In 2016, in another study done by Choi, Gutierrez, and Martinez, found that the government-owned banks played a counter-cyclical role during the financial crisis in all regions and experienced a faster increase in their loan portfolios than private institutions. In its 2017 survey, the World Bank found that more than half of the NDB surveys experienced greater growth in their gross loan portfolios than the national average in the respective countries between 2010 and 2015, confirming the counter-cyclical role they can play in difficult times. It has also confirmed that there are differences between the counter-cyclical role of NDBs in high-income and developing countries. In developing countries, 44% of development banks adopted counter-cyclical measures versus 67% of those in high-income countries. In other words, it was used more as a tool for counter-cyclical intervention in developed countries. Economists have also pointed out that state involvement can also have important negative effects on the financial sector. Therefore, as crisis conditions recede, the evidence suggests that it is advisable for governments to shift from direct, using public banks, to indirect policy reforms as interventions. And this is a variant of the infant industry argument. Bottom line is that if you continue to finance firms that are in difficulty, when times are improving, they won't grow up. The fourth point is that some national development banks have helped in promoting innovation and structural transformation. This has been achieved by the promotion of specific sectors and programs and products aimed at increasing productivity and boosting innovation. That is the model that EGFL has been using. Perhaps the best example is KfW, Germany's state-owned national promotional bank. It is the second largest national promotional bank in the world, following the China Development Bank, in terms of total assets. Its mission is to support the German government by implementing or expanding projects that would otherwise go unfunded by the private market. Some of its largest programs are in green technology, energy efficiency, SME financing, and export financing. I'd like to say that in the petrochemical sector in Trinidad, there are at least 3 of the 20-odd plants which have been financed by KFW, not the least of which would have been Clicomethanol. Founded in 1948 as part of the Marshall Funding Plan, its early projects focused on housing, agriculture, power, and the heavy industrial sectors. It started its first export promotion program and SME program in the 1950s, and its first environmental program in 1984. It has linked, promoted, and been at the forefront of German industrialization and the investment in Germany, and funds projects by German companies worldwide. In the last 10 years, it has developed new financing programs for student loans, environmental protection, SME, energy efficiency, and even the refugee policy. As an aside, well, I think I mentioned that already, that it was responsible for funding energy projects in Trinidad. The 5th point is that NDBs can play a role in enhancing the financial inclusion by providing access and credit to those who do not have enough access to improve employment levels and income distribution. Of course, this is the part that always frustrates commercial bankers. I have to say that given my experience at EGFL, the frustration wasn't in that what it did was in how to deal with it. And I have to say that EGFL has learned more than a few lessons in handling that particular sector. And in the process, I have to say, so did I. The commercial reality is that not all companies and or ventures can access credit. Some are stymied by size, by scope, or by sectoral hurdles. Growing a sector requires a delicate balance of policy, assistance, and guidance, and in some cases, a soft touch. It ought not to be along the lines of welfare programs or assistance to the boys and girls with political connections. They must be properly structured, operated, and managed on an arm's-length basis to aid in capacity building. A suitable example of this objective can be found in KFW and the Canadian Development Bank, who are both successful in SME lending. And I want to say that during the time that I was chairman at EGFL, I'll have to say that on every occasion where we ran up with the fundamental issue of political connection, requesting favorable, or if you want, dispensation with regard to the provisions of funds, I have to say economics won and politics lost. And I thank Mr. Simmons for supporting me in that regard. I think in one particular meeting, my point to him was, I could say no, you have a job. He said no too, and he kept his job. The 6th point is that NDBs can be used in some countries to support the provision of public goods, rural and export financing, and address climate change challenges and promote environmental sustainability. The leading examples of these are KFW, the Brazil Development Bank, the Credit Guarantee Corporation of Malaysia, the Export-Import Bank of Malaysia, and the Banco de Desarrollo de El Salvador. And the 7th and final point is that national development banks can also play in reducing infrastructural costs and project identification. The best example of that is the Brazilian Development Bank. Those who oppose development banks, and national development banks in particular, argue that any form of government ownership of banks results in lower financial development. 2, that it fosters a lack of transparency and a tendency to support privileged economic groups. 3, that they are heavily subsidized. And 4, while governments can assist a country in time of financial repression, incomplete and inefficient capital allocation, long-term government-led credit allocation can hinder the effective development of efficient capital markets. That, of course, does not apply in the Caribbean region because our financial markets are less than efficient. In fact, our problem is that we don't have enough volume and mass to take on the capital requirements for growth. There are merits and grounds for some of these criticisms. At the root of the issue is the scope the role and scope of the government's control and involvement in policy, management, and the direction of organizations. An examination of the mandate, operations, and governance routines of some of the national development banks confirm that the NDBs are susceptible to a loss of focus and effectiveness due to its relationship with government. In other words, you can tend to have a soft policy choices, and you tend to support perhaps matters which need not be supported. This, however, has not been my experience with the Enterprise Good Fund. The World Bank cautions that unless the institutional framework of a national development bank is strong enough to withstand political pressure, that's an important point, which means that the board has a critical role to play, a national development bank can become vulnerable to political interference or be captured by interest groups exerting pressure to take on excessive credit risks, causing financial failure due to losses. Now, that perhaps may have been the experience of the Barbados Development Bank, which ended its tenure as a result of a condition of an IDB loan. Whilst the issue of whether to price products and services at market interest rates or subsidized interest rates is a matter of concern, the World Bank survey has revealed that 49% of the institutions reported that they only offer loans priced at market interest rates, with the remaining 51% offering market-based and or subsidized loan products. Those that offer the subsidized lending must ensure that the subsidized lending does not compromise the financial soundness of the institutions. In other words, development banks also required to operate on a prudent basis. And that's where the governance routines come in. Whilst the issue of whether to price their products and services at market interest rates is a matter, well, sorry, I said that. The last major concern is that the government-led credit allocation can hinder the effective development of efficient capital markets. In the Caribbean, this is less of a problem, as our capital markets are indicated are still in the formation stages. The biggest myth relating to development banks is that we in the Caribbean seem to be particularly susceptible to is the mistaken belief that the establishment of a development bank is enough to effect sectoral and or change and or economic growth. The reality is that it cannot and never will. A national development bank is a specific tool created for a defined purpose and a role in a financial architecture of a country. It is not a panacea. And like any other tool or organization, its effectiveness depends on its mandate, its management, its leadership, the stakeholders, and how it adapts to changing situations externally and internally in its own market. Most importantly, it depends on the suite of policies adopted to improve the ease of doing business by the government. What are the lessons to be learned from this cursory examination of development banks around the world? First, national development banks are mandate or mission-oriented institutions, and care must be taken in the formulation to be really effective that their strategies and policies must be integrated into a national development strategy articulated with focal ministries and agencies. In other words, the institution by itself, yes, I have water, thank you. But I'm not using it. The bottom line is that the development bank by itself cannot achieve the change. It must be done in conjunction with a suite of policies. And the suite of policies are not the responsibility of the development bank, they are the responsibility of the government, and they must complement it. One of the difficulties, or one of the most effective management tools employed by the Singapore government is the simple concept of a balanced scorecard that works in the ministries and across sectors. A simple form, a simple idea, but artfully practiced. KFW is a relevant example. It was designed with an economic outlook to compensate for market failures and to promote underfunded, socially beneficial projects. It is backed by the German government, cooperates with commercial banks, has access to policymakers and regulators, and it works in tandem with government policy and a wider commercial policy objective, a wider macro policy objective. But it is also done on very rigorous private sector lending requirements and also a rigorous evaluation of the projects which are undertaken. In other words, not every project that comes gets financed. They choose the best. It serves an advisor to new economic and promotional legislation and has in-house expertise, financial and engineering, that provide more detailed knowledge of economic trends. In other words, it is not just simply doing a textbook analysis, it actually has people in the fields who are experts in their own subject matter areas. It employs experts with specific sector knowledge in agriculture, energy, natural resources, and engineering, just to name a few. It makes more technical decisions on its investments rather than simply relying on the market. Secondly, national development banks must work on improving their reporting and governance structures and on project origination and development. And that is one of the critical issues I think that faces EGFL and any organization in the region. Deal flow, the amount of deals that we get, and what do we choose from the deals that we get. And sometimes, this is also not politically acceptable, if they aren't good, you have to reject all. And that, of course, creates problems with the minister. Sometimes you have to tell the minister no too. Not only is this important for good management, the chairman has to tell that, chairman. Not only is this important for good management, but for longevity and the viability of the institution. And by the way, that happens in private sector organizations too. Government ownership and participation ought not to be an excuse to allow weak management or weak management structures. Risk must be appreciated, understood, evaluated, and costed. The organization must be allowed to grow, to adapt, and to reposition. Of course, this also causes organizational issues and difficulties with the policymakers. It must be free from government control and interference in its operations and given the opportunity to lead and develop through capacity building and institutional strengthening. And mandates must be reviewed and adjusted to deal with changes in societal needs, lest we continue a pattern in the Caribbean of rebranding and or creating new organizations. In the case of Trinidad, for example, the IDC became TIDCO, became TDC, and TDC has now become 3 organizations. Mandates must be reviewed, yes, and adjusted. But we have to have defined outcomes. In other words, what are we creating? What do you want of it? And you have to measure it. That question of development effectiveness and developing the matrices that allow us to come to some evaluation as whether we're doing a good job or not. So what is the way forward? It is said that the failure is not fatal, but failure to change may be fatal. The world is changing, and the Caribbean must change and adapt to survive. Larger developing nations, in particular the BRICS, understand this. Witness the changes that we have seen in China and some of the changes that Brazil is also currently going through. They also understand that development takes time, requires planning, it requires building human and institutional capital in a virtuous cycle. And capacity building takes time, and it must be focused. Notwithstanding our issues relative to scale, growth, sustainability, and sagacity, we need to find a way to learn from the lessons of our past and the experiences of others. Time is not on our side. Former Australian Prime Minister and Treasurer Paul Keating said this, and I quote, "Politicians and political parties exist for one purpose and one purpose only, to safeguard the people while making the required and continuing changes to the fabric of their economies and their societies. Politicians who are in the business of politics but not in the business of change, let their communities down badly. The political game is about and only about getting changes through. Bureaucracies are more than capable of running an existing system, but bureaucrats are not capable of changing it. The great curse of modern-day political life is incrementalism, moving change along millimeter by millimeter, taking few political risks while pretending to be the elector's friend. Mandates for paradigm shifts in an economy or society belong only to politicians and to the political system. They can never belong to bureaucracies. Bureaucracies have no political power on which to draw. What they do, sometimes well, sometimes clumsily, is to flitch morsels of power which they use to incrementally move along their own agendas. It is no accident that in countries where bureaucracies have been in the ascendancy, we find generally slower rates of growth and slower rates of income growth. Decisive cabinet government, aided and abetted by a competent bureaucracy, is the highway to change. In the Caribbean, we have established national development banks. Grenada Agricultural Development Bank in 1965, which became the Grenada Development Bank in 1980, the Development Finance Corporation of St. Kitts and Nevis formed in 1969, which was succeeded by the Development Bank of St. Kitts and Nevis in 1981, the Bahamian Development Bank 1974, operationalized in 1978. In Trinidad and Tobago, the Development Finance Limited, the Agriculture Development Bank, the Home Mortgage Bank, the Trinidad and Tobago Mortgage Bank, and the IDC. In Barbados, there was the Development Bank, Barbados Development Bank, and we now have the Enterprise Growth Fund, which has a mandate to provide venture capital to small and medium-sized enterprises. And in Belize, the Development Finance Corporation. Yet our experience shows that many of these organizations have not been properly optimized and or utilized. Our experience has shown that we need to be more practical and functional in some of the following areas: the mandate, staffing, and resource allocation. The funding has to be appropriate to the task. And the way we manage these institutions and the people who lead them, our approach to governance, accountability, and the measuring of outcomes and results. Financial performance ought not to be the sole yardstick and or measurement. The role that we expect stakeholders to play. Management must be allowed to manage and the boards to set policy, but we must avoid the tendency to take an organization as an extension of the government of the day. Organizations need to be built on strong and robust principles that will survive. We must also address the future role of the organization in society and the long-term needs as distinct from the short-term needs. Finding funding or specific sectors today need to take into consideration where we need to have the country placed in the next 25 years or 25 years from now, at least. And we have to pay particular attention to how these institutions integrate into the wider financial framework and government policy. If we fail to define, plan, or to prioritize our development agenda, the short and long-term objectives, no institution or policy on its own can make a long-term meaningful difference. We will just be wasting resources to meet short-term needs. In Barbados, we are in a difficult economic time. It may even be a crisis, but in any difficult time or crisis, there's an opportunity. And if we waste the opportunity, we do so at our peril. So what is the opportunity for us in these challenging times? We have not had in Barbados the cash resources like some of our other Caribbean counterparts or friends to the south. But I have always admired what has been a strong sense of responsibility and a willingness to do what is right and what is required to secure its future, a sense of responsibility perhaps that has been missing in the political directorate in other countries. No names called. There is no magic bullet, only a simple but difficult task that must be done with consistency, determination, and persistence. We must determine and build on our economic strengths. Building human and institutional capacity is as important as improving the ease of doing business. But what is more important than the harmonization of our monetary and fiscal policy with end-to-end improvements in regulatory and trading environments? Our actions and organizations to play their roles in this task. Organizations must lead and be managed to fulfill their mandates and the country's. 21 years ago, I played a small role in helping to kickstart the EGFL. It was meant and did supersede the Barbados Development Bank, which had to be closed as a condition of an IDB sector loan. And as it suffered from continuous losses, and the role of the government was to be limited. The initial capitalization was a modest $5 million. half of its original target. In fact, the original target was 12, not 10, if I remember correctly. Right? With some private sector financing to provide venture capital, advisory services, and technical assistance to small and medium enterprises to be managed as a private sector-led organization. The private sector never seriously bought into this idea of funding a development financial institution. And whilst it has not withdrawn its original investment, it never expanded it either. So the extension of its funding has largely been provided by the government. 20 years on, it has largely delivered on its mandate in a financially sustainable manner. The fact is that it has survived, which is a little better than the Barbados Development Bank. So in that, the first issue is to survive. The first challenge in any business is to survive. The second issue is to continue. It has developed a strong corporate governance framework, and it has, in a sense, it still continues to do venture capital loans to a maximum of 1.5 million on its own account or in accordance with the sector-specific funds for which it acts as trustee or manager. And there are several funds: the Agriculture Development Fund, the Energy Smart Fund, the Export Promotion Fund, the Industrial Investment Fund, the Innovation Fund, Small Hotels and Investment Fund, the Tourism Loan Fund. So in large measure, EGFL has met its purpose, has met its mandate. Perhaps we need to do a little bit more evaluation of the sector-specific areas. We know that the SMEs have grown largely in this particular period, much of which has also been funded. But the key lesson and the key development objective, in a sense, has been set by the report from the Global Entrepreneurship Monitor Report in 2011, from which the following quotation is taken. Barbados cannot grow by focusing and competing with other energy-efficient driven economies, since it does not have the market size or access to comparative level of resources. Therefore, to grow the economy, it must become innovation-driven and to focus on developing unique products and services for export to the rest of the world. Barbados has great potential to continue its economic development through greater emphasis on entrepreneurial activity. And this activity needs to focus on high growth areas with the potential to create employment and to earn foreign exchange and to increase the GDP per capita. And as I wrap up, I want to share 3 thoughts of Drucker. I couldn't keep track of speaking and do the slides, so you have to forgive me. All right. The slides contain largely what I said. So maybe I kept you focused on what I was saying. So Mr. Drucker, and it's important that Mr. Drucker, probably one of the foremost and greatest management exponents certainly of the last century, and his words continue to resound at the beginning of this. First, long-range planning does not deal with future decisions, but the future of present decisions. Whatever decisions we have to take into consideration the future that we wish to create. 2, the relevant question is not simply what we shall do tomorrow, but what should we do today in order to have a tomorrow. And 3, to survive, every organization must turn itself into a change agent. It is not only about having institutions, but the successful and the most important difference between a successful institution and a failing one is the quality of its management. That's perhaps one of the defining lessons of the Clico disaster. We must learn how to manage, lead, and use these institutions not for political objectives or patronage, but for human development purposes. A national development bank can be a powerful tool. It can effect meaningful change, but its success or failure is rooted in its mandate, its systems, its processes, and most importantly, its people. All have a critical role to play in its success and benefits to reap in the form of a more developed Barbados and a more productive economy. Thank you, ladies and gentlemen.